Unlike my mom's favorite pastime, penny slots, penny stocks are actually a viable investing vehicle with the potential for real return. Nothing against slot machines, but personally, I'd rather put my money into the stock market. Ironically, penny stocks are, to some, the equivalent of gambling due to their volatile nature. But what are penny stocks? You might have heard the term, but have no idea what they are or how they're different than quote-unquote normal stocks. Well, this is Kim, and in this video, we're gonna look at penny stocks and see how they might or might not be something you'd like to invest in. Ready? Let's go! So, in a nutshell, penny stocks are stocks that trade for $5 or less. They're typically traded over the counter, or OTC, which means they aren't listed on a major exchange like NASDAQ or the New York Stock Exchange. Penny stocks are considered riskier than other investments because they can be volatile, and volatile prices often mean higher risks, as well as bigger rewards in terms of profits, if your investment does well. You may have also heard that penny stocks are speculative investments, but what exactly does that mean? According to Investopedia, speculative investing is the act of putting money into financial endeavors with a high probability of failure. It means you're trying to get super high returns from investments that could really go one way or the other. Some liken it to gambling, but it isn't quite the same since there is an element of research and educated decision-making at play. However, the inherent risk is still very high. Imagine you buy a stock in the Finance Park Gold Mining Company. It's hard to know if this company will actually find a viable gold mine or not. If you believe through your own research that the company might strike it rich, then you may buy the stock on a hunch. This is speculation. Another attribute of speculation is that they're often held for short periods of time, and speculative investors typically move in and out of positions quite often. The key to being effective with speculative investing is that research is key. So does this mean penny stocks are risky? Penny stocks' risk comes from infrequent trades, a lack of information on the companies, and the challenge of buying or selling the stocks, especially since many are not even be traded on major exchanges. For example, many penny stocks do not have a bid-ask spread, which is the price difference between when you want to buy and when someone wants to sell. So, if you're looking for a specific stock and can't find it in your search engine, chances are that it doesn't exist at all. Penny stocks' volatility also make them unsuitable for long-term holding periods due to their high level of risk associated with small capitalization companies without established track records or earnings history. If you are thinking about investing in penny stocks, there are some things to keep in mind. First of all, the majority of them are less than $5 per share, which puts them in the microcap category. If a stock is trading at $2 per share and has no debt or other liabilities such as royalties, then it's considered a microcap company. Microcap companies tend to trade on the over-the-counter OTC market rather than on major exchanges such as the New York Stock Exchange or NASDAQ. And those can be more risky environments for investors because they're not regulated by any government agency like these larger markets are. Second, don't expect much liquidity when buying these stocks. You may find yourself waiting days or even weeks between when you place an order and when your shares arrive in your account. That's because there is not enough volume being transacted in these stocks to support an efficient market system, where prices move smoothly up and down based on supply and demand. So while they may look cheap compared to other stocks out there, don't expect that discount to persist indefinitely. It'll probably go away almost immediately once. So before you invest in penny stocks, it's important to understand the trade-offs between risk and reward that come with penny stock investing. Penny stocks are risky investments because they're often thinly traded and may not be listed in major exchanges like the New York Stock Exchange or NYSE. This means that there will be fewer investors trading these companies, which can reduce liquidity and make it difficult for traders to buy or sell shares at market prices. In addition, many companies don't list their stocks on an exchange. They create their own markets instead through direct contact with investors via phone calls or emails. Because of this lack of transparency about where these shares are being held and traded within various markets, there are no official records showing how many shares exist, thusly making it difficult for investors who want to get out quickly. Indeed, penny stocks are a little bit confusing and not for the faint of heart. They have great risk, which also means potentially great reward. But whether you take a chance on them really depends on if you're someone who can tolerate that level of uncertainty and risk. While the idea of penny stocks is interesting, I personally find them a bit too risky. I prefer to put my money into broad-based index funds and ETFs. In fact, I like to employ what I call the lazy investing strategy. which allows me to have a portfolio that is well balanced and poised for profit. If you like the sound of that, then click on this video where I go into a lot more detail. See you there!